Right, welcome to this special TPP program. So Thursday, 5 p.m., it's always time for TPP. Yeah, so put that in your diaries, your favorite time of the week. And we've got a special program today. We had to do something special for today. And I think we've achieved it. Got a super special guest on today. And we've given him extra time because we really want to hear what he's got to say on this subject. I'm going to stop talking because I always talk too much, but I'm going to welcome Mitesh. And most of our viewers are familiar with Mitesh. He's from our mortgage broker. But listen carefully. Put down your coloring pencils, all these things. Put them down. Put down your crayons. Get out your writing pens, take some really good notes. You're going to learn some fabulous stuff. This guy really knows his stuff. That's why we brought him on here. Mitesh, I'm going to try and stop talking. Over to you, sir. And I'm going to let you introduce the program subject because I'll probably muck it up otherwise.
Okay. So I think one of you needs to allow me to share my screen.
Srinder, put the 50p's in, please.
50p's should be there.
Oh man, you're cutting back on the 50p's, are you?
Not the 50p's. I put the 50-pound notes in, remember?
Yeah, all right.
Okay, I think the 50 pounds just gone in now.
Yeah, there you go.
Okay, so I think we've got actually a special session today. It's a hot topic. I can assure you it's a very hot topic. So before we go into the hot topic, just want to introduce briefly about myself. So I'm Mitesh Manek. I'm a mortgage broker. I work for a company called Our Mortgage Broker. We're a team of 8 advisors based in Bracknell. You've got a direct mobile number for me on the screen, email address and a website so you can explore about who we are, what we do. But I'll give you a bit of a flavor of kind of what we do at the end as well. So in terms of the hot topic today is those famous words that everybody keeps on talking about, especially during this time of the year, and that's BRRR. I know many of you have come across this scenario before. Many of you have attended sessions before, seen lots of YouTube clips before, and I just thought today, from a mortgage broker perspective, I'll go into some of the finer details on kind of the whole concept of BRRR. So I guess you're trying to understand, what it stands for, with some of you who have not come across this scenario before. So let me just try and break it down for you what this is all about. So the first B is in terms of buying the property itself. So I guess it's important to understand where you're buying the property from. So is it auction? So I guess you're looking at a scenario where you're trying to buy a property where you can add value, which is why I wanted to go through those options in more detail. So an auction is probably going to be a good starting point. You could pick up a bargain, do your research. You know how it all works at auction. So there's plenty of guidelines there on Google. You can understand how it all works. Private sale. So I've seen transactions where there's been a lot of private sales happening, and it's not a big issue for lenders, even if it's a private sale. I know in the past I've had scenarios where a lot of lenders actually refuse transactions because it's a private sale, and they've insisted that it goes through an estate agent, for example. And lenders do evolve, and this is an area where you could pick up a bargain. So when I say you pick up a bargain, I know at the moment times are hard, so you may have clients with a portfolio of properties and are thinking, I have an opportunity where I can invest somewhere. I'm short on cash. They may want to offload a property from the portfolio. You may be knowing that client. You also might be a professional landlord or an experienced landlord, and you may think, we'll try and strike a deal. And so this is where you're trying to buy something that's kind of below market value, I would say. And I guess there's kind of value in this proposition when you're looking at transactions like that. I put estate agent days because recently, in the last 3 weeks, I've had 2 estate agents I've helped out, and they're really, really happy. because of the fact that they've got lots of landlords that they're looking after their properties, and they're actually finding that some of these landlords want to offload their properties. And so what tends to happen is, if you've been with an estate agent for 10, 15, 20 years and that estate agent's been managing your properties, you will probably strike a deal and say to the estate agent, if you can sort something out quickly for me, I trust you. And this is what I'm hearing: I trust you, and you can take the property off me, and I'll knock off 30,000, 40,000 off the price if you can complete quite quickly, because I really need the cash. And I'm seeing a lot of those type of conversations where people are trying to get hold of cash quickly, and so they're willing to let go of properties at slightly below market value price, which is why I've put that down. Because if you've got good links with estate agents, it makes a big difference. And normally, if you think about it, if I am a client of a estate agent and you're also a good friend of an estate agent, then I'm sure that if the estate agent is not in a position to buy the property, then I'm sure they'll give you a call and say, look, I've got something here, you might be interested. So it's important to maybe, keep good contacts with estate agents, especially this time of the year. Then the other area I thought I'll introduce is the rundown properties area. Why? Because this concept works very well, especially if you've got a scenario where you're trying to add value to the property. And I explain a bit in more detail how that works and why that's important. So rundown properties will be properties where potentially, let's say if it's needs something fixing. It could be the roof, could be windows, it could be the interior, and I think it helps if you can get a bargain like that, because it could be that there's been a lot of interest in the property, but maybe the type of investors that are going in there maybe don't have enough money to do up the property, and you may be in a more sort of different position whereby you've got plenty of cash flow around, there's plenty of cash around, or you've got a good broker that's managed to secure some finance on your portfolio and you're ready to draw down, and that puts you in a much better position to have more bargaining power to try and secure a rundown property. I'm sharing these points because these are things that I'm hearing from my clients, and so I thought it's good for me to share this with you. Literally every day I'm hearing one or two of these things that are coming up regularly from my clients: auctions, private sale, estate agents, rundown properties, and the last one I've got there is property with planning consent. So these are the type of inquiries I've actually been seeing where my clients are actually going down this route, which is why I'm sharing this with you all today. So property with planning consent, which means there's an option further down the road, 6 months, 12 months, depending on how you plan your projects, to try and do an extension or whatever it might be that you may have in mind. It could be that you're thinking of HMO, again a hot topic area. So I just thought I'll sort of give you a flavor, especially if you're kind of starting out, you're thinking, what should I do? This is just kind of give you an idea of kind of where to look for properties if you're trying to especially apply this strategy. So I guess the next area is the first R, and that's to do with refurbishment of the property. Now I've put on there light refurbishment. It's just important to understand the difference between a light refurbishment and a heavy refurbishment. So light refurbishment is to do with things like changing carpets, bit of paintwork, new kitchen, something that isn't going to necessarily alter the structure of the property. So I don't want to go into too many finer details on this area because of the fact that I'm aware every lender has a different definition of what light refurbishment means or heavy refurbishment means based on their criteria, which is why it's very difficult for a broker to try and really give you a pinpoint answer of what they think a light and a heavy really is all about, based on the fact when you're especially trying to look at finance options, because lenders would have different products available depending on a light refurbishment or a heavy refurbishment that you're trying to go for, especially when you're trying to get finance. So it's important to understand, the difference between the two. Again, and I've said this time and time again, always best to prepare in advance. You're thinking about something, make sure you've got the right power team around you. I'm sure if you don't already have a power team, then you should be looking at the right type of accountants, right type of convincing solicitors, architects, builders, mortgage brokers. You really need a power team around you in order for this type of concept to really work. Otherwise, you could get really, really stuck. And it can be very time-consuming exercise from some of the past experiences I've had with clients. So, which is why, if I'm mentioning something, it's probably because, I've seen my clients go through that, and I really don't want, somebody to go through that process again, because it can be quite time-consuming and also very stressful. And I've then put on here, obviously, heavy is all to do with structural change. So you're thinking side extension, I want to build something on top of, on the second floor, so I'm doing a third floor, doing an extension, knocking off walls, and that's where you're going down the heavy side. So that's your structural change, really. That's why I'll put that in brackets. So it's easier to understand the difference between the two, broadly speaking. And then I've sort of put on there, keep those invoices. So I've had scenarios where clients have said to me, I spent tons of money on this over the last 6-9 months on the property, and I'm looking at refinance with you later on. And I've asked the question, so wow, you spent so much money. Wow, it sounds really good. Have you kept those invoices? And I've had 1 or 2 clients that said to me, no, I haven't. And I said, why? They've decided to do a cash job. So they've decided to pay the builders, or the builders have said, I'm really sorry, we'll have to do this in cash. Now, that in itself could potentially cause a problem at the point when you're trying to refinance the property. So I would say, as much as possible, keep those invoices. Just from a lending perspective, it will work in your favor. I'm not saying that it will close all the doors for you. All I'm saying to you is that it will work in your favor. So the next one, we already touched on it. It's refinance. Quite logical, because you're thinking then, now I need to refinance. Now I've put on there repay a bridge. Why have I put on there repay a bridge? Most times my clients, obviously, when they're purchasing a property like this, would need to go down arranging a bridge finance route. So you can't get a term product straight away like a normal buy-to-let, for example, because of the fact that you're making changes to the property, but at the same time you're saying, I want to look at the end value, the higher value of this property after I've added value to the property, because I know it'll be worth more. And so what I'll rather do in 6 months, 9 months, 3 months, whatever time period it is to mortgage the finance that I've got in place, which obviously at that point you'd have taken a bridge finance, which mostly clients would do that, because that's the obvious route to go down to purchase property, and then to repay it. And so what you're saying to the broker is that by the time we come down to repaying the bridge finance, because I've added value to the property, we should be able to repay what I owe to the lender and get a bit more out, so that it becomes a good investment proposition for me. Because remember, if you go down a traditional transaction, let's say if this scenario is not there and you're going for a normal transaction on a standard property where nothing's happening to it, you're not changing anything, then you go for a normal term product where you generally get tied into the deal and there'll be a repayment charges. And so you then, even if the market conditions were that after 6 months the property was worth 50,000 more, you wouldn't be tempted to break that deal, because there might be a high repayment charge to pay. So repayment of the bridge is there because that's normally what tends to happen. Why have I got there the extension of bridge finance? This is an interesting area to understand, because what tends to happen is that when the lender's already provided you the finance for you to buy the property, do the works, and they've assessed everything. Sometimes, based on your timescales, you might find that you are running out of time to repay the lender. And so if that happens, there's a very good chance that if it's, let's say, a 9-month facility or a 6-month facility or even a 12-month facility, that you may need to then remortgage the bridge finance, possibly to another lender. So that is a possibility that's there, depending on how your project runs, and you shouldn't get scared. It is something that sometimes does happen, and it is an option out there. Don't be scared that what happens at a 6-month period on the deal, because obviously now the deadlines come about, the lender's asking for the money. What should we do? You can negotiate with the existing lender as well, or we can get an option to remortgage the bridge finance to another lender. Obviously, at that point, you'll be doing a valuation. If the valuation figure is slightly higher at that point, because of the market conditions as well, and maybe already done quite a bit of the work anyway, then it should work a bit in your favor based on the numbers. However, it is going to be expensive. I'm not going to lie, because obviously there will be additional costs involved to do this, the arrangement fees, another valuation cost, and so on. Buy to let. So why is the buy to let there? Because in reality, what tends to happen is that you're potentially looking at trying to retain the property and get tenants in, because you'll be thinking, by doing all this work, I'll be able to get more rent, rather than the rent I could charge at the point of purchase. And so you then, at the point whilst you're doing this transaction, look at the option of getting a buy-to-let mortgage towards the end, to see how that fits in based on your project and the numbers that have come about, especially at the point when the valuation is carried out. Because at that point, you really know whether the buy-to-let option is going to be a viable option. I'll go into more detail. I'll go into more detail a bit later on, in terms of how it actually physically works overall from start to finish, when you look at the whole refinancing from the point of purchase to the point of exit, because it's important for me to cover that within this subject area. Otherwise, you'll get a bit of information here, a bit of information there, but you won't be able to see how everything comes together in the end as a transaction. Now I've put on there bridge to let. So you might be thinking, this is getting now very confusing. We're talking about bridge now here, we're talking about extending of bridge, now we're talking about buy to let, and now we're talking about bridge to let. What's going on? Okay, bridge to let is actually a scenario where what the lender is saying is that in order to keep the cost down, what we can do is that as a bridge finance lender, we also provide buy-to-let term facility loans as well. So what we could do is we could look at your proposition, get the value around based on the numbers you're thinking. The value will come back to us, and they'll tell us, because they'll know exactly what's happening with the property in terms of what you're trying to do in terms of the works in the property. So the value comes around and says, based on currently where the client's trying to buy this property, the location and everything else around it, this is what we think the property is worth. After the works are finished, this is what we project what the property is worth, and this is what we project what the market value rent would be like, which is what you normally get on a buy-to-let transaction. Is you get the price agreed by the valuer to say, yeah, that price makes sense, or you're paying over the odds, or and at the same time they're telling you what the achievable market rent at that point is. So those numbers come back to the bridge finance lender, and what the bridge to let means is that you're getting two sets of terms at the same time, the bridge finance terms and the buy to let terms at the same time, agreed by the lender. What that allows you to do is gives you peace of mind to say that at least I know that I'm eligible for a buy-to-let mortgage at the point of me committing to this transaction, rather than thinking I'm going to look at other lenders in the market nearer the time and then see who's providing the best deal, who's providing, free valuations and so on, who's providing, products with less fees and so on. And it's a bit of a risk at that point. It's not that you can't do it. Well, I'm saying that this is an option where you then save on valuation cost, legal cost as well, if you think about it, because the same solicitor then is looking through the whole transaction from start to finish. So hopefully that gives you an idea what a bridge to let scenario is all about. Now, why have I put down there cash purchase refinance? Now, generally as a rule of thumb, we would say that if you're going down the cash purchase refinance route, what that means is that you actually bought the property in cash. You didn't really need to then get a bridge finance. You had your own funds. You also potentially then had some funds. Maybe it was a light refurbishment project. We needed maybe £30,000. You had that as well, and you thought, you know what? I'll then take my time and then look at refinancing. Now, on a cash purchase refinance option, the best advice I would say is to try and wait 6 months. The reason why I say that is because the lender would be more willing to look at that open market value based on what you think the property is actually worth after a 6-month period of the purchase date. So it's important to just sort of bear that in mind, and that's what we found in many transactions when there's a cash purchase, is that the figure that the value is looking at tends to differ if there's been a 6-month period in terms of how the property has been valued. It is one of those areas where, again, it can get very complicated, but what we found, especially in the last 6 months, is that this is what the lenders would prefer. And in reality, I'm sure many of you who are landlords and you've done remortgages before, you've probably found quite a few times a broker would have turned around and said to you, I can't place the case with this lender because they require you to wait for 6 months before you own the property. So there's a bit of logical sense in that argument to say, why that 6-month rule is there. This is what lenders would do. Okay, and the last R is the rent. So again, I just thought it'd be good to sort of understand in terms of what exactly or which area you're looking at, what exactly you're doing, because that will have an impact overall in terms of what you're achieving in terms of the rent at the end. So I've put on the explore the area. What I mean by that is look at properties in that street, do some research, talk to a local estate agent, and have a look to see realistically in terms of the project I'm trying to do, would I be able to attract the right type of clients there, in terms of tenants there in that property based on what I'm trying to do. So is it an area where there's lots of students staying, for example, and you might be looking at HMO, and that's the route I'm trying to get at. Is it an area where I'm looking to get a family? Would a family go around and live in that area? So maybe explore those options. Rental demand, so explore with the agent to see what you can get. Now, one of the things that a lot of clients maybe there's a bit of misunderstanding when we look at the figure that you actually get and the figure that the value puts on the valuation report. It's always been an area of discussion between a broker and the client. I've realized that a lot, especially because of the fact that 80% of my business is all dealing with portfolio landlords. It doesn't really matter at the end of the day what figure the value is putting down on the valuation report, as long as you're getting the money, because your tenant could be paying £200-300 more a month for that property. So in reality, on completion, if you're going to get £200-300 more than what the figure's been put down on the valuation report, it's a win-win for you. So you shouldn't be really concerned about what the value of things. I get a lot of arguments from clients. This is not right. It's been valued wrongly. This and the other. At the end of the day, it doesn't really matter, because what really matters is what you're going to get at the end when the project's finished. So that's why I've maybe expanded a bit more in this area, just to say, just be mindful that if the value is putting down £1,400 in rent, and the market rent you think, oh, you don't get at least 1,600 because that's what your agent's saying to you, and you've done comparables with 3 different agents in the local area, and that's the minimum you're going to achieve, and you end up getting 1,650. Guess what? You're the winner then. Huh? It doesn't really matter what the lenders think at the end of the day. So maybe just don't get too stuck up on that whole idea of why is the lender doing this and why is the value going around and doing that. And remember, these are values that are independent. Yeah, these are not the bank's values physically that are sitting in the office that are going around and valuing the properties. So I wouldn't be overly concerned about that. And the last bit I've put on there is use a spreadsheet to work your profits out. So I assume you're doing this because you're thinking, I'm going to get money out of it. Now, in today's climate, this whole idea of making profit may not seem that attractive, because obviously, based on the amount of labor cost and other costs that's involved in trying to refurb a property, maybe slightly significantly higher compared to maybe, let's say, 6 months ago, and your profit margins may be squeezed at the end. And obviously, if you do a spreadsheet, it will tell you that. But you need to ask yourself the question: am I really doing this because of that £200 profit a month, or am I doing this for capital growth? And it is something that you have to ask yourself the question. What I would say here is that what I have found based on the transactions I've dealt with is that you do really need a lot of time on your hands in order to be able to do this and see this through. A lot of communication with a broker, a lot of communication with other parties in the background, the lenders there, solicitors. So you do really need a lot of time. It is a project. You do have to then spend a lot of time. Obviously, you've done a lot of research in the first place before even you've approached a broker for looking at the finance. So when I look at the overall scenario, it really does tell me that it requires a lot of time. So make sure you have the time on your time on your side to be able to do something like that. Okay, so I've added an extra R just for fun. No, it's not for fun. It's there because it basically is telling you that a lot of people actually repeat the process. They like doing this because they've seen value in doing this rather than just buying a standard 2-bedroom flat, for example. So I've put on there, repeat the process. So it's definitely worth doing it because you get more experience, you understand how it all works, and lenders are more willing to help you because you now become very experienced in the sector. And clients sometimes forget that, is that lenders are more happy to lend to clients that are experienced in this process because they've done it before, they've gone through the pains, they know, they've become very wise, they're planning carefully for the next project, and so lenders will be saying, yeah, bring them to us and we'll be happy to lend. Okay, I wanted to touch on some of these areas today because of the fact that some of these current market conditions are very important for viewers and listeners to understand what's happening right now, especially with looking at things like lenders' timescales. On average, right now, we're seeing that when we had times where we used to say to clients, give us 2 to 3 days and the lenders will make a decision. And that used to be the norm. 2 to 3 days initial underwrite. What initial underwrite means is you've done an application, you've got the documents from the client, you know exactly what the lender wants at the initial stages because the lender can ask for more documents, but you know as an experienced broker what are the basic requirements. Basic requirement generally tends to be if you're self-employed, last year's accounts, or it could be last 2 years personal tax returns with the tax overviews, things like 1 month's bank statement or 3 months of the business bank statement. And as an experienced broker, you know one latest bank statement if you're employed, one pay slip just to show credits coming in, just get a basic idea of kind of how your income and outgoings are showing on the bank statement, just basic information. And normally brokers would have that information up front. And so when they submit the application, all those documents attached within 48 hours, kind of you know where you stand with the lender. Underwriting's done, valuation's already triggered. That's not the case these days. what we're actually finding is that lenders are taking sometimes up to 2 weeks, before you come back to you and say whether they want more information, whether they're happy. The application sits there in pipeline because lenders are extremely busy. So I thought it's very important today, especially to mention this, because I've said this before in my videos. I know that you plan ahead. If your deal's coming up for renewal, if your deal's coming up for renewal in 6 months' time, start the process now. And it's the same scenario. You have to look at valuations as well. So valuations, why is it there? Because some properties are getting downvalued. So your situations might in terms of your projects might not sort of happen to in terms of the numbers might not add up because of the fact that there might be a 10% reduction on the value of the property because the value has gone around and valued it and said look, I think it's a bit overpriced. So all I'm saying to you is that I'm not trying to scare anybody. All I'm saying to you here is that just be mindful of these things. These things are happening. Some of my colleagues in the last 2 weeks have seen that at least 80% of the applications are having these issues. I don't know whether it's to do with the fact that there are too many messages out there to say prices have gone up here and there, and we think it's 8-9% higher, whatever. Maybe that's a reflection. I don't know. I don't have all the answers, but I'll be mindful of that as well. So why is it on there right now? Is because it allows you to then manage your time. And I mentioned this earlier in the other slide. It's about time management. Don't leave it too late. Your broker saying to you, pass me all the documents up front quickly before you start putting offers in, is because they want to make sure by the time the offer's put in, they can quickly process the application for you and trigger all the right processes, whether it's underwriting, valuation, all that quickly, so that you know where you stand with the deal. Ultimately, that's what you want to get to. You really want to get to a point where the offer is issued, so that at that point you know that the lenders agreed the deal. The estate agent's confidence. So that's important, yeah, because obviously we need to make sure that the price at which you're buying the property at, are you being gazumped? Is there an issue with that property not being sold? It's been there for more than 6 months. So you need to just maybe check, and if you've got a good connection with the estate agent, then you know how they're feeling based on the location where they're based. So maybe that might be an area, and that's why I've mentioned the word about estate agents earlier. It helps just to get a feel. Interest rates. So why is it there? Because you've heard recently with rates going up and what the scenario is in terms of the fact that interest rates are going up. So the time, especially on the residential side, we used to see rates below 1%, 1.5%, 5-year fixed rates. All those days are gone by the looks of it, for the time being anyway. And rates are more in the range where they're above 2% on residential deals. That's all I would say. I don't want to go into too much detail, but it gives you an idea of the shift in rates, especially on the residential side. On the buy-to-let side, it's steady. There's not been too much of a hike on the buy-to-let side, so you'd be pleased to know about that. Then in terms of buy-to-let market lending, so why is it there? What we've realized is that we've got quite a few number of new lenders in the last 6 months that have come into the market, and so lenders have got money to lend, and they're happy to increase the loan to value. So in terms of the deposit you put down will be less than what you think that's required, and so market is booming in terms of especially the buy-to-let market. So again, it's on there just to tell you that it's not all doom and gloom or other stuff I've mentioned. Lenders have got the money to lend, so it's not like there's a standstill or there's an issue. However, rates are getting pulled from time to time. So I've had a case today recently in the last 48 hours. I've had to provide the client 3 different rates. So from the time I started the application with the lender, it didn't fit the rate obviously that I tried to get to the client. Obviously I couldn't give, and then I went to the next lender, and it took a couple of days to try and figure out whether we could lend or not. And within that period, there was 2 rate changes already, and I was shocked that there was already 2 rate changes within 48 hours. And so what must have happened is that they were virtually in that time frame where they're thinking, there's a lot of allocation of funds on this particular low rate. It was a pretty low rate. We need to maybe pull some of these deals, and we're seeing that a lot, especially some of the attractive rates are being pulled. And what we're also seeing is that lenders that are actually extremely busy, they're actually withdrawing the rates on purpose, because of the fact that obviously what will happen is they'll probably deter the clients going to them for the time being and go to other lenders, and so they'll give them a bit more breathing space and allow them to catch up on the work and get back to normal with, let's say, to assess applications within 5 working days. And that we're seeing that as well, because that normally tends to happen. Because what happens is you get a lot of complaints that why is my case taking too long, and then the lender realizes maybe we need to do something about it, and the most logical, common sense thing to do is to increase your rates in the short term. The last thing I've put on there is debts unsecured. So just be a bit mindful that you don't ramp up a lot of unsecured debts, especially when you're looking at buy-to-let proposition, because some lenders may be a bit more cautious about lending to clients where they've thought, I'll spend some money here because I'm doing some work in the house, spend money on another card, that card, this card, go on holiday. I know it's holiday season. Just be a bit mindful about that. Is not to have too many debts in the background. Just a bit of a red flag sometimes when we look at propositions with buy-to-lets, because all lenders are a bit different when it comes to looking at debts that are held in the background. Hope that's been useful. I just want to share with you a Trustpilot review that I've had recently, and that on here, this particular client had a very difficult case. They had 2 cases, and they'd gone through 2 different channels. What channels means 2 different brokers, and they found the whole process very confusing, and because it's 2 propositions, it was getting a bit difficult, and we were quite lucky that I managed to convince a lender to take both the cases on, and it was done using a discretion through context we had, and it was the right time for us to do it because the lender had the appetite to accept the deal, and the deal went through. So obviously we had a very, very good client. But again, sometimes, like we mentioned about the bridge to let option, all that, sometimes it's better to stick the finance with the same lender, so that it's easier, peace of mind, and obviously you're saving time. Again, I mentioned the word time quite a lot. You've got my details here. So I'm a specialist mortgage broker, deal with bridge finance, commercial, development finance, second charges. I mentioned about second charges recently on a presentation. Portfolio buy-to-lets, residential, personal business protection. Got my details on the side, and then we've got another slide that's just giving you an idea of the team, who we are. I'm the thin guy there, second on the left, if you've not noticed. And hopefully you found the presentation useful for today. It might be a bit lot to take in because I've covered up a lot of concepts on the finance where you may not be aware of, but feel free to reach out if you want to get more information. It isn't the easiest area to understand, especially when it comes to finance. So various different ways of buying, various different ways of financing, and are you using your own money for the projects, you're stuck on cash, whatever. I'm stuck on cash in between, what do I do? That we've had problems do occur in this project. So I would say make sure you've got contingencies in place, or speak to the right type of broker, because an experienced broker will be able to tell you what happens if something goes wrong, because obviously they've had experience on dealing with cases like that. So I'll stop here, and I'm happy to take any questions.
Right. That's fascinating. I was so into making the notes. Thank you for that. It's interesting looking at that BRRR as many R's as you like from the finance perspective.
That's right.
Surinder,
Yes, sir.
Before I get going on my questions, have you got any?
Well, let's start with one.
Okay.
Which is, say I'm buying a property,
Mm-hmm.
and I know there's some works to be done to it.
Mm-hmm.
Let's say it's a light refurbishment,
Yeah.
either a kitchen replacement or something like that, and painting.
Yeah.
Can I find a lender
Mhm.
who will lend to me? Will say, fine, this is your initial lending
Yeah.
on the thing, and after you've done the works, we'll top it up.
Yeah, so you definitely can. So most times we would say that if you've got the funds available to do the works, then it works in your favor because you've got the lender asking less questions.
Right.
Otherwise, they will drill into the numbers a lot. They will find out who you're using as an architect or builder. They might want a CV. And so especially if you're an inexperienced landlord. So when I say inexperienced, is in you're doing this project for the first time. If you got, let's say, at least 3 years experience in this industry, then I know a lot of lenders will say if it's 3 years or more, then we won't ask too many questions because we'll say, this guy knows what he's doing. They might ask projects, details of the projects you've done. So I've had clients, the lenders have said to me, all we'll ask for is find out what are the projects that have been done. So it's important to have your
I mean,
folder ready.
this is a very light refurbishment. I could have
Yeah.
had estimates from B&Q for
Oh,
the,
okay.
the plumbing
Yeah.
and things and the painting.
Yeah.
I mean, that's all I'm talking about
Yeah.
to start with.
Yeah.
But if it's a structural one, then I know we'll have to.
That's right. That's right. I mean, for lights, but you'll be surprised if you go to a lender, especially who's offering very cheap rates and they're this market space of being very busy as well. You'll be surprised. Sometimes at an underwriting stage, they'll ask more questions. All I'm saying is that you'll probably find that if you have done this before, there'll be less questions asked. But having said that, that's why I mentioned the word first time landlord. But there isn't really a problem. The reason why I'm saying there isn't really a problem because it's a very common thing that happens in the market. So lenders are used to saying this a lot. So whenever you have issues with lenders on certain transactions, because maybe, especially in that particular niche area, maybe they haven't seen a lot of it. And sometimes, like when I talked about second charge in one of the presentations recently, there will be a panel of lenders that just do second charge mortgages. So they're used to all this. They're used to all the quirkiness. And so that's why it's important then again, and I keep on saying this, I think my MD has also mentioned this before, is that we'll do our research and make sure that we're finding the right lender to place the business. Again,
I mean, second charges are good, but the lending rates for second charges are at least twice the first charge lending.
You'll be surprised because of the fact that now rates are going up and up, that it may not be as much as twice, and that's what I'm realizing. The reason why sometimes the second charge option works better is because of the fact that you can pick up fixed rates without early payment charges, and that's where the beauty is. That you're safeguarding yourself against hiking interest rates, and you're saying fixed monthly payments, setup fees are a bit lower. Rather than doing a second charge bridge, paying less interest, let's take a second charge. You know what? The lender doesn't really care. 3 months down the road, I'll just clear the finance off.
Yeah.
So this is where you need a good broker where they will research the market. They'll give you a cost comparison. They'll tell you if you went down this route, this is the costing. Went down this route, this is the costing. Drawbacks of this route is this. Drawbacks of this route is this. You need to sort of pick and choose what you think is best. If you're looking at time frames, and I mentioned I think in the presentation earlier, there isn't legal works involved in the second charge. Not solicitors there are doing this and the other. It could be quick. Again, time. If you need the money quick, you have to really make the decision. And as I said to you, that's why I mentioned the whole idea of time scales.
Be
100%. Very mindful. You're trying to. Everybody is rushing to do all this right now. So if you're going to go to a lender that's extremely busy, then be prepared for those delays. So you have to really again talk to somebody like myself who is aware of all these areas, because I do deal with this type of inquiries. So I'll have an idea of how long it takes for a buy-to-let application, a bridge application, a second charge application, and so on. It just helps because I'm constantly talking to the lenders, and that's one of the things that we do regularly, and we started again regularly as well as a practice, is to invite those lenders to come to offices. We're actually moving offices soon in terms of getting a bigger place where we're at on the 6th of June, and we're trying to now keeping that momentum going, because what we are finding, and even the MD is saying to everybody, is that oh my God, within 2 days, there's so much changes happening. We need to try and get the same lender again that we had a conversation with 3 months ago, because they've suddenly revamped and changed their criteria, brought out these new rates, EPC number rates on based on EPC ratings, and the list is endless. It's going up and up and up. Before it was half a page, now it's a page and a half. It's like, wow, adverse credit, stage 1, stage 2, stage 3, stage 4. What's happening? Even within adverse credit, there's stages. It's like, it's a minefield sometimes. So it's better than to re-engage with those manager contacts that we've had, invite them, understand kind of where the appetite is. We talk about our challenges. One of the things that we ask the lenders all the time is, what are your challenges? Have you got the money to lend? Have you got your backing at the moment? Where are you finding those issues? And where are your wins? Where are areas where you're winning business? Because we want to know that, because then so that we get a case, we're thinking this guy actually said to us that this is areas that they would like to lend on, or different scenarios. And so this is one of the things that we do a lot within the practice, to understand which lender is liking what type of business. Where is it that it's taking too much time? What is that's getting stuck and getting declined? Because if something gets declined, we have to then find another lender. You're just wasting everybody's time. No?
Yeah. So Mitesh, you did one of your previous programs for our viewers.
Yeah.
That should be on YouTube. Great program on why you need second charge mortgages.
Yeah, that's right.
Sorry.
Right.
And I think one of the case studies you pointed out was that where you've got a fixed rate mortgage and you don't want to disturb that, you're better off topping it up with a second charge. So yeah. And just picking up on the light refurb.
Yeah.
A viewer should note that a loft conversion or rear extension is not a light refurb. So
it's not a light refurb, but you'd be surprised sometimes when you look at lenders' criteria on what they classify as a heavy and a light, or especially when you look at the type of rates they're willing to give you. Sometimes there's some lenders that are a bit more lenient on what they classify as heavy, and you might be lucky to pick up something that's maybe a 0.15% a bit cheaper because it's not too heavy, if that makes sense. So that's why I said I'm not going to go into too much detail, because every lender obviously that's down to us as brokers to obviously do the research. But in a nutshell, you're right. That's what generally what it means.
Yeah. So this is a really interesting topic, and you watch YouTube and social media. This is always hyped up and so on. But from you see the different perspective. What do you see as the challenges of doing BRR or RRR?
It's a good question. I think what I find is that clients run out of money, and that sometimes becomes the biggest challenge for us, because then we're trying to look at assets in the background. Can we do those second charges? How are we going to release cash? You don't want the client then to start borrowing on credit cards here and there. Second charge bridging is there as well. So you want to avoid all that, really, because obviously it's costing you money. So that is a biggest challenge that I'm seeing. And also, clients are not experienced sometimes, and then they commit to something because they're desperate to commit for whatever reason. Competition in the area, let me buy this, and then that way I don't have a lot of competition, and I'll be fine, because I'm also I've got a business down the road, so I'll do something else with this property, because I don't want another person coming there and running this or that, various reasons. Or this is a fantastic opportunity, once in a lifetime, let me go for it. And what it is sometimes is that it's all good intentions, makes sense. In 5 years down the road, you double your profits, all makes sense, but then you're not prepared. So you haven't prepared about deposits, what you're going to do. Having said all that, if you're doing a bridge finance, you need to get a loan agreement done with somebody. Lenders will be happy to do that. So it isn't that there aren't ways of trying to secure the property, but all I'm saying is that just be prepared. That's why I mentioned simple things like a spreadsheet. You'd be surprised sometimes when you have a very good spreadsheet and you present that with a lender. They sometimes don't ask too many questions, because they think, this guy is very good. He's actually looked at all the costings, he's done all the homework properly, the presentation looks really good. On the presentation, you're presenting the proposal to the lender, for something this expensive. If you do it in a professional manner, sometimes the underwriter will be thinking, looks really good, very well presented, they know what they're doing, that's fine, we've got faith in this person, it looks like he's got all the grounds covered. At the end of the day, the broker would probably know what questions the lender will ask, so they'll call that off with the client. Backup, finance, portfolio in the background. My last case, I remember questions were asked, and I said the guy's got a capital repayment portfolio. You imagine, I was having an argument with the underwriter. I said it's a repayment portfolio, not an interest only. It's a repayment. That's how my client is. Can you see the equity in the property? Each property has got at least 40% equity. I can tomorrow do a remortgage and raise cash. I can tomorrow get a second charge. Money is there. Why are you getting too concerned? You want an agreement principle? It will take me 2 minutes to do. All I have to do is punch in some numbers and I'll get an agreement principle. And the agreement principle is just basically trying to give you a document that shows that at least your credit is clean. It doesn't do a lot more than that, because you can put any fictitious numbers and you'll get the right results out. But you don't want to go down the route. All I'm saying in general is that if you're prepared, and the broker would know that if there's options out there in order for this to be done, because you've got a portfolio in the background, that helps a lot, helps a huge amount in trying to secure the lending, because you're going to provide that information up front to the lender and say, look, don't worry, if this is not sticking and you think that the property will be down value by 50 grand, then here's a portfolio for me to fall back on to bridge the gap. And I would do that up front, and I've done that in some cases, and I've had terms issued like that, because I know the lender is going to be thinking that straight away, and that's quite normal. And you can imagine why, because they've seen cases where things have gone wrong, so they have to be cautious as well, and make sure that they don't overexpose themselves, and then you come back and then say, like, I'm stuck, help me, what can I do? And it's a bit embarrassing as well on both sides, isn't it? Because you don't want to be in that position where something's gone wrong, halfway you come back. And if it happens to the lender time and time again, then I'm sure that there'll be some investigations going, because it doesn't show responsible lending.
Yeah, just in connection with that,
Yeah.
You raised an interesting point. You said, is cash buying better than refinancing?
Yeah.
A little bit more detail on that, if you wouldn't mind.
So, cash buying better than refinancing. So, if you don't have too much time on your plate and you've got the money, then it helps, because obviously you don't have to go through brokers, solicitors and everything, and going around the circle to try and make sure in a good time frame, meeting the deadlines, everything's sorted out. And you can imagine, we haven't even talked about solicitors in the whole mix. So you have to be very careful in terms of the fact that it allows then you to complete something in good time, and also it gives you a bargaining chip. Because you're a cash buyer, there's a very good chance you're knocking off a bit of money off the price maybe. And what then that allows you to do is you're in more control of your project, and that's the reason why I mentioned it. And then you come back to broker when you're nice and relaxed, everything's done in good time. The only pressures you're facing is with you and your builder, technically, and maybe party wall. I don't know, but
Yeah. That we have to deal with that pressure.
Exactly.
Yeah, that's our pressure to deal with.
Exactly. And so we're coming at the end of all those pressures are being sorted out. Everything's done and dusted, and they're saying, look, 6 months are up. What can you get for me? I'll get most of my money back, and I'll move on to the next one.
It's very interesting. I mean, I know a lot of brokers say, no, always do finance, but you're saying it's the client's interests that are the priority, not us doing business. So time
and the pressures. Every day we're facing pressures. I know I don't talk about pressures on the job and all that, but this is not an area that's very, very straightforward, because obviously when you look at finance in this type of projects, there's always an issue in terms of trying to get the most lending. What do I do if I run out? Show me other ways of raising cash.
What if the plan is to do a flip? Do something and sell?
Very good. So that's a good question. So if you're trying to do that, then obviously you may not need to sort of explore the whole bridge to let option. So I mentioned about the bridge to let. So which means that you may then decide to opt for maybe the cheapest lender in the market, rather than a lender that's offering the bridge product and the buy-to-let product. And that means that you may think and go to the broker and say, look, let's go for the cheapest, as long as we trust that lender, because the idea at the end of the day is for me to then sell the property. So that's why I think that's a very good point. So the bridge to let scenario again is becoming like a fashionable thing these days. It wasn't there in the past. It's now become very fashionable. When I say fashionable, as in lenders are thinking, you know what, we're seeing the issues when we're doing bridge finance. What if we did have a term product? And oh, okay, so cost of living's gone up. If we did this product, then you know what, the cost saving on valuations, legal fees is huge. So maybe it's worth exploring that option. And that's what I'm saying.
Of course, the lenders are always in the market to make more money.
But then at the same time, they're also evolving and thinking, how can we provide better, different products and differentiate ourselves from other lenders? And you know what I'm finding is that if a bridge to let scenario is offered by, let's say, 3 lenders, and then within 3 months you now have 6 lenders that are offering bridge to let, that's telling you these guys are not stupid. They know there's value in this, there's demand for it, and so that's the reason why they'll do it.
They can't see you.
Sorry, I was thinking.
Yeah, well, thinking.
Yeah, I was going to do a comment on being fashionable, but I'll save that to the end. Have you got any other? I mean, that's a good point, Surinder. Actually, Mitesh, well done for putting that across. Surinder, have you got any more questions?
Yeah, when people go, they're the first time buy to let landlords or whatever, they apply for a mortgage.
Yeah.
Is there a minimum level of income they have to have?
So remember, when we're talking about BRRR, normally these clients are looking at options where they're doing bridging. But you've actually raised a very good point, because even with a strategy like this, you assume because it's bridge finance, the lender's not looking at rules on affordability and things like that compared to a standard buy-to-let application with a prime lender. Having said all that, when you're doing a BRR strategy, when the lender's looking at an assessment, they would probably like to see that there's income in the background for them to be able to then allow you to have the buy-to-let proposition at the end of the project as an exit route. Because ultimately, some of the things that the lenders are looking at is, do you have surplus savings in the background to cover void periods? So one of those areas is that what they're going, is exactly what they'll be looking at, is that. So because remember, this is not a transaction where it's a remortgage, it's a transaction where you're buying, no? That's why it's the BRRR. So they're thinking, if we are lending up to this level, they've done the bridge, we need to look at the profile of the client as well. If something goes wrong, especially if you look at the cost of living crisis and all that. What if you don't have tenants in the property? So they all think, normally it's things like, do you have at least 3 to 6 months sort of funds available to cover the monthly mortgage payments? And so it's areas like that the lenders will be looking at as well. I've just touched on one, but the profile of a client, especially if they're working. Remember, some of these clients are actually having normal jobs, and they're doing this as a side thing. Or it could be the husband's working, wife is doing the project. So they will be looking at that overall. Again, we haven't touched on things like whether you do this project under a personal name or limited company name. But again, that's where you need an accountant to advise you. Mitesh,
is it better to have one lender that does bridge and then to buy to let, or do you want 2 different ones? What's better?
We're driven by the client's needs, and it's a good question you raise, because you could pick up a bargain on the rates if you decide that you want to leave the buy-to-let proposition till later, until the project's almost finished, and then doing a remortgage. And that way you'll have more choice of lenders to choose from. You look at what rates are available in the market and decide at that point. Having said that, you're going to then take a risk, because you don't know what's going to happen with rates. You're going to have issues around acquisition costs potentially. We don't really know. So it is a risk you're taking, but it may give you more choice. Whether if you do the bridge and the buy-to-let with the same lender at the outset when you're doing a proposition, then that allows you to just give you peace of mind to say, look, I'm saving on costs. I don't want the hassle in case criteria change, Because remember, these projects could be 9 months, 12 months. If criteria change in 12 months' time, what are you going to do? So you have to weigh those options up. But we would give the options to the client and say, you pick and decide.
Very good. Client first. Right. So look, Mitesh, it's a fascinating subject.
Yeah.
We could go on for a lot more, and Srinder's got some great questions, but I'm sorry, Srinder, we've run out of time, so we've got to disappear shortly.
Yeah.
But before we go, talking about fashion, I see on the last program you had a red tie on, and today you've got a blue tie on. So I'm guessing what that means is you don't care which party comes in, as long as you're the man in number 11. Yeah, is that what you're trying to say?
No, what he's trying to say is he likes what Rishi did.
No comment. We're not a politics program. We're not a football program, and we're definitely not a food program. But listen, Mitesh.
All I would say is that if you have a red tie on, or a blue tie on, or a purple tie on, and you've got a blue suit, you're keeping, the red's happy and the blue's happy.
Yeah, well, let's not go into that one. This might turn into LTV's Liverpool, and we'll be in proper trouble. Look, okay. Right, Mitesh, look, really appreciate you taking time out, doing this special program for us. Really interesting subject, bringing some great insights for us. And we look forward to seeing you on the next one, and keep these programs are fascinating. Thank you very much for sharing your knowledge.
Yep. Thank you, Mitesh.
Thank you.
And
we'll see you on the next one.
See you on the next one. And remember, everybody, Thursday afternoons, 5 p.m. It's time for TPP.